Welcome to Accounting 4301, Financial Accounting. We call this course Financial Accounting because its sole domain, although it does operate at the fringe of taxation, its sole domain is in financial accounting. Intermediate accounting, the two intermediate accounting courses address to a limited extent managerial accounting. In this course, we're going to really focus on just financial accounting and reporting. Here we'll address 5 financial accounting and reporting topics that build upon our understanding that we developed in Intermediate Accounting 1 and Intermediate Accounting 2. Here we're going to address some topics that integrate some of the ideas that you were introduced to in Intermediate Accounting 1 and Intermediate Accounting 2, and of course build upon our conceptual understanding of the way we go about preparing financial statements. In addition to new topics in this class, we're going to dive deeper into 2 topics. So we're going to dive deeper into accounting changes and errors, and we're going to dive deeper into cash flow statements. And we're going to challenge you to develop your accounting research and analysis capabilities in this course. One topic we'll address is revenue recognition in some significant detail. According to FASB's conceptual framework, revenues are inflows or enhancements of an asset of an entity, or settlements of liabilities, or some combination of inflows, enhancements of assets, and settlements of liability from either delivering or producing goods, rendering services, or other activities that constitute the central or the major operations of an organization. So we're not talking about ancillary things, we're talking about things that are central to the operation of the organization. In simpler terms, simpler than FASB's definition of revenue, a more narrow definition but is easier to understand. Revenue is the inflow of cash or accounts receivable that a business receives when it provides goods or services to its customers. For many companies, revenue is the single largest number reported in the financial statements. So measuring and reporting revenue is critical to good financial reporting. 2 fundamental issues that we'll deal with in revenue recognition. 1, how much revenue to recognize, that is to record. And 2, when do we recognize that revenue? And the core revenue recognition principle is that we should depict the transfer of promised goods and services to customers. We should depict the transfer of promised goods and services to customers. And so we'll talk about the core revenue recognition principle, how we use that principle, as well as the 5 steps that we follow in applying that principle. Accounting for income taxes. Revenue recognition follows a 5-step process. Accounting for income taxes follows a 4-step process. And this 4-step process helps us to carry out the accounting for income taxes. We could just record income taxes on a cash basis, but like other things, we want to record income taxes on an accrual basis, which means that we're going to have to think about something that has not yet appeared on the tax returns and some things that have appeared on the tax returns that should be reflected differently in the financial statements. So this will use in income tax accounting. For several years now, we've used what we refer to as an asset and liability approach, or a balance sheet oriented approach to accounting for income taxes. The 4 steps: first, we're going to calculate the tax payable. That's in effect, if the tax return is not yet prepared, then you're going to project how much taxes will be owed on the tax return. Second step, determine the necessary ending balance of deferred tax accounts. So we've got certain deferred tax accounts. We've got to calculate what those ending balances should be on those deferred tax accounts. And what does it take to get those deferred tax accounts from the balances they're holding today to the balances that they need to hold. So I need to know how much they are today. I need to know how much they need to be in the future. And then what I'm going to do with tax expense is I'm going to plug tax expense, because I'm going to get if the beginning balance sheet is right and I create a correct amount on the ending balance sheet, then what needs to flow through the income statement with respect to income tax expense, it just falls out. It's just in effect a plug. We also need to address the accounting for post-retirement benefits. So the key elements of a defined benefit pension plan, which is the central topic of this chapter, post-retirement benefits typically come from defined benefit pension plans, although we'll talk about some post-retirement healthcare benefits that are accounted for in a similar fashion, perhaps not quite as challenging. So the key elements of a defined benefit pension plan, one is the employer's obligation to pay the retirement benefits in the future. So as part of the contractual arrangement between employer and employee, I'm going to pay you less now, but I'm going to put some money aside so that you can get paid more later. Those plan assets that are set aside by the employer to pay those obligations later, that's the second element that we need to be concerned about. So the first element is this obligation to pay. Second is the assets that have been set aside for later payment. And then, of course, I've got to figure out what's the periodic expense to charge with respect to the pension plan. The first of those two elements, the obligation to pay and the resources set aside to make those payments, typically in financial accounting and reporting, we would not net those out. We would report the obligation and we would report the asset. In post-retirement benefits, in the case of pensions, we net the obligation against the assets set aside with respect to that obligation. And so this method of netting those is different from what you've done for the most part to this point. And so it's going to create some additional accounting entries and some additional disclosures that need to be addressed. And so that's what we'll be doing. We'll also talk about post-retirement health insurance for retirees. Accounting changes and errors, we addressed those in Intermediate Accounting 1 somewhat briefly. We'll spend more time with those here and work out some of the nuances there. In practice, we encounter changes in accounting. So we start off with kind of the idea that we set up the accounting standards are the same, and we just keep doing that. But in practice, accounting standards change, and companies choose to implement accounting standards differently now than what they've done in the past, and so that leads to accounting changes. Also in practice, what we find is occasionally we make errors, and so we've got to figure out how do we address the mistakes that are made in the accounting, either made by us or maybe a predecessor accountant. Most changes in accounting principles are reported prospectively. We just deal with those going forward. Most accounting changes are dealt with prospectively. We do have changes in the entities, so sometimes companies change and they're not exactly the same company as they were before. We tend to deal with those retrospectively, and errors we tend to deal with retrospectively. So we'll spend some time on working out some of the details about when I use which method of making the accounting adjustments. And then we'll see that there's also a modified method that we find that we need to use in some cases. Our final set of materials has to do with cash flow statements. You've worked cash flow statements probably a little bit in your first Principles of Accounting class. You've dealt with cash flow statements in your first intermediate accounting course, and now we're going to spend some more time with cash flow statements. Conceptually, there's not a lot of new material in that chapter, so I've moved that one towards the back. I think it's probably not the most conceptually challenging for you, and it will be the one that you'll be completing just before the final exam. We'll deal with the usefulness of the statement of cash flows. We'll readdress why those statements of cash flows are useful. And they are useful. We didn't used to provide statements of cash flows, but in fact the investors demanded that we add statement of cash flows as the package of financial statements that are provided to investors and potential investors and creditors. We'll redefine cash equivalents. That's fairly straightforward. We'll have to deal with operating activities, both the direct and the indirect methods. Since we have a little more time for coverage here, we'll spend more time on calculating operating activities, both the direct and indirect method of doing that. And then, of course, there's a classification that most of you learn the basics of. really hasn't changed, so we'll cover that again. You've got certain activities that are operating activities, certain activities that are investing, and some that are financing. You need to know the difference among those. And then the one last thing that we always try to make sure that we don't forget when we prepare a statement of cash flows is don't forget those non-cash investing and financing activities that need to be disclosed kind of supplemental but with the statement of cash flows.